Let's get ready for Monday Mortgage Minute with your hosts, Tom McNamara and Bruce Woodburn.
All right.
Hey, Bruce.
Happy Monday.
Yes,
All
sir.
right.
Monday again.
Well, we actually have VA up here on the screen, but today we're going to do something different. We are going to do USDA in 15 minutes. So let's give that a little bit of a change here, and we will make that adjustment.
Yeah. So while you're doing that, USDA, something I haven't done a whole lot of, but I have done a few, and they've generally worked out pretty well. And it's a good program, but it's got a lot of rules.
You know what? Anytime you're going no down payment, the level of risk goes up. So the amount of rules go along with it.
Yeah.
Because when you increase risk, you actually have to have other things to mitigate it. So let's talk a little bit about the pros and the cons of a USDA transaction. First of all, the pros, no money down, right?
Yeah,
no money down. The only other loan you can do that on is VA. So this allows somebody that's not a veteran to come in and put no money down. Yep. So that's a big benefit. The other benefit is the seller can pay up to 6% towards the buyer's closing costs. So that's a big benefit as well versus say conventional 95% where they can only pay 3%. So it gives some advantage there as well. Now, there are other advantages, but now let's talk about the things that may cause some trouble, or it could be obstacles that could get in your way. First of all, the property has to be located in an approved geographical area that meets the medium density or the medium income levels for that area. And that changes from one area to another. So it depends on how many people are in your household, depends on how much money you can make. So there are income restrictions.
So almost like the down payment assistance programs where they're looking at your income. So you need to make enough, but you can't make too much. Right?
Correct. And obviously, the more children you have, the more money you can make. But there are income limits. And in most areas, if you make more than about $114,000, you're probably going to knock yourself out of that.
Yeah. Now, USDA specifically has something that's unique to it in that there's an eligibility map as far as even the property qualifying for USDA, right? And it's interesting because, clearly the USDA is the Department of Agriculture, and what the heck are they doing in the lending business, right?
They're not in the lending business. They only insure mortgages, just like FHA and VA.
Sure. But what are they, why is there a program like that? And it comes down to, it helps people in rural areas, which typically have more farmland and things like that, right? And one of the anomalies that I've run into is as a city grows out, right here in Orlando, we see it, people going out into the Claremont area or up into Eustis and places like that, where a lot of the area does qualify for USDA, but they've got brand new, nice, big homes and HOAs going up. And, normally those would not qualify, but for a small window, they will.
Well, that's because USDA does not update their maps as frequently as the communities build out.
Correct.
So even though some of these areas, if they were reevaluated now, would not qualify, but you might be able to get in on the tail end of this. And these maps are so specific. I've seen them tight that a house on one side of the street qualifies and on the other side does not.
Yep.
So we double, triple check those maps to make sure that your house fits within that area. And if you're listing a home, you should know if it's USDA qualified so that you could market it that way.
Absolutely. So what about non-occupant co-borrowers and boarders and things like that? Is there any rules around that?
Yes. So this is for owner occupied only.
Correct.
Consigners, no deal. Because you don't occupy. So only the people that are on the house, on the mortgage, living in the home can be on a USDA transaction.
Gotcha. Okay. All right. So
and
that's
all income in the household is counted.
Right. Now, what about interest rates? Are they comparable?
Yeah,
Is there any difference?
interest rates are comparable. The mortgage insurance is extremely low. It's 1% upfront and it's 0.5% monthly. It's really low, lower than FHA, almost as attractive as VA.
Got you. Okay. So what if I wanted to combine USDA zero down with a down payment assistance program where they can maybe pay some of the closing costs?
Well, you can oftentimes stack some down payment assistance programs together. I find that you're now having to navigate the rules for down payment assistance that are different than USDA. And when you put them both together, they can bang into each other. So
Gotcha.
oftentimes what I've done is have the buyer negotiate closing costs being paid on their behalf so they can get in just like a veteran for little or no money out of pocket.
Gotcha.
It makes
All
it
right.
a little bit easier.
Now I know we've talked about USDA before personally, and credit score can be a little bit of a challenge too.
They're
right?
very sensitive on credit scores. So credit's got to be pretty good and debt ratio has to be very low. And that's typically the first things that knock people out of USDA is their credit scores isn't high enough or their debt ratio is too high. If you exceed a 29% on the front end, it won't pass.
So front end, just to be clear, front end is your housing. That's your housing ratio. So 29% of your income going towards housing. So if you make 100K, you can only put 30K towards housing or 29K towards housing, which is just a little bit more than $2,000 a month.
That's right. So
and that's all of your housing. That's not just the PI, but it's the taxes and insurance as well, right?
HOA, everything that might apply to that. That's correct.
Yeah. So you got to be
careful.
careful.
Your overall debt, including your car payments, credit cards, and the mortgage payment, including taxes and insurance, can't exceed 43%. Go above 43%, it's going to knock you right out of USDA. So it is and just like down payment assistance, it's a narrow window, but it works for a lot of people.
Sure.
And it really helps a lot of people that really struggle with coming out of pocket with any money. So if you've got good credit, you've got low debt ratio, but you're struggling on cash or you just don't want to use a lot of your own, it's a great option. Now, USDA also allows for the seller to pay up to 6% toward your closing costs. So that's going to cover all your closing costs easily with 6%.
Sure. Yeah, that's actually quite a bit. And then private or mortgage insurance. I know that they don't call it PMI, but it basically works like
it's called it's called the guarantee fee. And it's just like mortgage insurance, and it is very low comparatively speaking to FHA and even conventional loans. So you keep it very attractive.
Awesome.
You also, on the closing costs, let's say the seller wasn't willing to pick up all your closing costs, but the house appraised for more than what you're buying it for, you can add those closing costs into it. So you can finance closing costs on a purchase. You can't do that on any other type of loan.
Gotcha. So as long as the house appraises for more than what the purchase price is, you can borrow up to the appraised value.
That's correct. Now, there's a couple of things you have to be aware of with USDA. It's not for opulence. So they don't tell you that you cannot have a pool, but the pool value has to be subtracted from the purchase price or the appraised value, and that's the most you can finance. So that appraiser has to subtract that value. So every time I've got a person that's buying a USDA and it's got a pool, I can tell you right off the bat, we're probably going to have a problem with the appraisal.
We're probably hoping it's an above the ground pool instead of an in the ground pool, right?
Right.
You don't want it to be a cement pond.
Yeah. The other thing that's very unusual with USDA, and it will creep up and bite you if you're not aware of it. USDA does not allow any of the borrowers to be authorized users on any accounts. So if your daughter was getting a USDA loan and she's an authorized user on one of your accounts, it disqualifies her until she's removed and the credit report is updated to show that she's been removed.
Wow. That seems kind of silly. I mean, you could always put her right back on.
It's so silly, but it is their rule. And it's happened to me before. And boy, those are the things that happen to you one time and you don't let them happen again.
Sure, sure. Now we talked about debt to income and we talked about income. So how do student loans and child support play into that if those are things?
Well, anytime you have any debt, it has to be included in it. And USDA has their own formulas, much similar to FHA and VA for calculating student loans if they're deferred or there's no payment associated with them. So all of those things have to come into play. So, and that's the case for any type of loan. If you've got a student loan, the first thing that the client does is call me and goes, well, you don't have to count that, Bruce. It's in deferment and I'm going to get it removed. Well, either you get it removed or I have to count a payment based on a formula. So, and that formula is usually 0.5% divided by 12.
0.5% divided by 12. Okay.
That's right.
So what about time frame to close?
You know, we don't generally have any type of issues when it comes to USDA. We can close a USDA in 30 days. If we have to close sooner, we can close sooner. Now, keep in mind, things that will hold you up on a USDA that realtors and clients need to be aware of. If it is on, then you must have a well analysis. Mm-hmm. That requires a culture in a laboratory. Yep. So those can take a few days. If it is on septic, you will need a septic analysis. Those are requirements, just like VA. You have to have them if you are on well and septic. So allow yourself enough time during the inspection period to be able to get through those processes.
Yeah, good point. What about two different types of homes on the opposite ends of the spectrum? So new construction and then manufactured home. So how do those fit?
Interesting that you say that. So new construction's no problem to do USDA, okay, as long as it fits within all the parameters.
Yep.
When it comes to manufactured homes, only new delivered from the manufacturer. You cannot go back and get a USDA loan on an existing unit. It has to be brand new from the manufacturer or the dealership.
Gotcha. So it has to be new. That's a really interesting one because you got to think in a lot of rural areas, a high amount of the housing stock is mobile homes or manufactured homes.
They definitely have not made it user-friendly for rural areas that would lend themselves more to the manufactured home. It'd be interesting if they change that in the future, but they want to make sure that since these people are getting in for little or no money out of pocket, that they obviously don't have a lot of money for future repairs. So they want to make sure that these homes are very, very stable. And they also don't want them to decrease in value. So if you have an older manufactured home, that thing could have deferred maintenance that ends up being a little bit more than what a typical single family home might have to deal with. So there are other issues, and I can't read into the minds of the underwriters of USDA, but those are issues and you have to be able to navigate through them. As long as you know the rules, you can then navigate through it. But it's a great product. It's a great alternative if you want. If USDA doesn't work, then look at FHA. Oftentimes, like I said, people get kicked out of USDA because it doesn't either meet the geographical location, or they make too much money, or their debt ratio is too high, or their credit score is too low. So save 3.5%, and we can do an FHA loan.
And then FHA takes care of all those problems.
That's great.
We've got a few seconds to wrap up. Anything that I didn't ask you about USDA that I should know?
No, I think that we've covered just about everything. Look, everyone's different. Don't compare your insides with somebody else's outsides. The best thing is for you to have all the information that you need to make an informed decision, and we're here to help you. We provide every loan product. We don't want to steer somebody in the direction of one or another. We want to find the product that's going to meet your needs. So if you need our help, all you got to do is reach out to us. Tom and I are always here to help.
Bruce, as always, been very, very helpful. And I'm not even sure what we're going to cover next week. Maybe DSCR?
Let's do some DSCRs on that one. That's a great idea.
Good.
See ya.
Have a great week.
Yeah, you too.